Hey, what's up guys? So today we're going to talk about how can you trade in a ranging market so they can profit from a sideways market. Now whatever I'm sharing with you today, again, it's not meant for you to trade live. Basically, what is a ranging market? Visually you can tell, okay, the market is going sideways. So it's just going sideways, it's not going down, it's not going up. A lot of people would call a ranging market as a consolidation market, and some people just call it sideways market. The easy way to determine it is visually, just look at it like that. But if you want to be certain, a little bit more certain, then you add in a resistance line and a support line. So you find that price would test this range, this support resistance line for a couple of times before it breaks and then go on the downtrend or uptrend. So if it breaks downwards, then you'll go on a downtrend. If it breaks upwards, then you go on an uptrend. And you can put your TP and stop loss based on these levels, but not exactly there. You want to put it further apart because most people is going to put their stop loss or TP target right at the point, which you don't want to do. And you need to understand that when you're a range trader, you would have a lot more opportunities to trade as compared to a trend follower, because the markets would range about 70 to 80% of the time depending on the currency. This means that market will trend 20 to 30% of the time, but you know what? Use both strategies, range trading and also trend following. And don't use this for all currencies, because certain currencies, they don't range as much. Certain currencies, they range almost all the time. For example, Euro Swiss franc. One reason being because the Swiss economy is very dependent on the Eurozone, and also if you look at the map, Switzerland is pretty near to all the Eurozone countries. So Switzerland, they export a lot of stuff to Eurozone. That's why they depend on them so much, because Eurozone is their loyal customer. So when two countries are very dependent on each other, you see price range more often. Okay? Now that's another way that you can determine whether the market is ranging or not. You can use a confirmation indicator. You can use MACD to tell you, okay, whether is this a ranging market or not, whether you can take advantage of it. Basically, when MACD forms higher lows while the price is moving sideways, this is a confirmation that this is a ranging market. Now when it comes to the setting of MACD, you can use a smaller number as compared to a 12, 26, 9. Some people use 5, 11, 16. You can use whatever that you're comfortable with using, okay? So when you have confirmed that this is a ranging market, you can look for a trade on the third bounce. For example, right here. Or for example, right here. But be careful of false breakouts, okay? Now aside from currencies, the good thing about this method is that you can use it, apply it to other markets. You can use it for futures. Okay, you can use it for futures as well as the stock market. So before you go into range trading, you need to make sure that a couple of criteria is fulfilled. First thing first, you want to see visually that the market is going sideways, not going up, not going down. This means that the market would be very calm. There's no volatile movement, there's no nothing. It's just going sideways, a quiet market, okay? So like I said, no clear upwards and downwards direction. And also when the two country rely on each other a lot in terms of their economy, like if they export, import from each other's country, then there's a high reliance in both of them. And also make sure you pick the right currency pairs, okay? Like I said, aside from the fact that the two economies must be highly reliant on each other, the two currency pairs that you pick, okay, must also have a small difference in their interest rate. So if you're a carry trader, you want the difference of their interest rates to be as big as possible so that you can get a positive carry. But if you're a range trader, you want the interest rates to be as narrow as possible so that the currency is going to range more often. Now another way of seeing whether this currency ranges a lot or not is to back test, look at the past behavior. If you realize that, oh, this currency actually goes sideways all the time, then you can use it for range trading, okay? Just back test. And also when you study a past behavior, you need to take note of a couple of things. The first thing is, how long does the currency range? If it does range, how long does it range? And not only that, you gotta determine how many pips does it normally range for. Like you can say is the bandwidth. What's the bandwidth of the range? How wide is the gap? okay, in between the support and resistance. How wide does it normally range? Because different currencies would have different bandwidth. Different currencies will also have different ranging durations. Some currencies would range longer, some currencies would range for a while only before it breaks out, okay? And also make sure that the price still has ranging momentum while you're in a range trade, okay? You don't want it to do a breakout all of a sudden. And one very important thing, okay, make sure that you're an experienced trader before you go into range trading. Because sometimes when you're doing a range trade, you would be trading against the trend. Okay, so how can you trade the range? I'm gonna go through step by step real quick. Okay, first thing first, of course, common sense. You gotta find the range first, add that with confirmation. I already showed you just now how to determine whether it's a range with confirmation. You can just visually draw the horizontal line and then look at MACD if you want to. So if you know support resistance, you know that if it bounces off the third time, okay, you can say that this is a strong support. Now, I'm not talking about support and demand zones because that's a completely different thing. This is a support resistance line, not support demand zones, okay? So don't confuse these two things. So you will want to enter preferably on the third touch, okay, on the third touch. So if you're selling here, you'll be trading in a way against the trend because price is above this moving average, okay? And then if you're buying here, you're buying below the trend. But you don't have to be too concerned because this is a ranging market. This is not really a trending market. So I would say it's all good. It's all good. Okay, so once you've identified the ranging market, then right now you need to enter the market, okay? But not only enter, but you also need to make sure that you set your stop loss and then TP target. The good thing about range trading is that you can get a good risk to reward ratio if you enter at the right time. Now the thing is, like I said, don't put your stop loss right over here if you're making a buy right here, because most people is going to put their stop loss over here. And then you're going to get stopped out easily by false breakouts. As you already know, nowadays markets have a lot of false breakouts because way too many people they are trading breakouts. That's why there's a lot of false breakouts. So you want to put your stop loss slightly below the support line if you're making a buy. What is the gap? Okay, it can be 10 pips ranging to 30 pips depending on the currency, okay? Another currency that you can trade ranging is dollar CAD. So when you make a buy here, when you decide to make a buy here, don't just buy when the price immediately touch support line. You gotta wait for confirmation, okay? You gotta wait for confirmation. For example, when you look at candlestick patterns, when you see a bullish signal, when it has support, then you enter. And where do you want to put your TP target? You put your TP target right at the opposite. And also, like I said, be careful along the way. There's going to be a lot of false breakouts. Okay, a lot of false breakouts. And don't trade this bounce too often because momentum would probably have been exhausted on the 5th bounce, on the 4th bounce, even on the 6th bounce. So as you can see, the risk to reward ratio is pretty good. Okay, with such a good risk to reward ratio, just bear in mind that you'll be stopped up more often because your stop loss is tighter than your TP target, so the probability of it hitting your stop loss target is a lot higher as compared to hitting your TP target. But you're not concerned about that because you're concerned about waiting for the big win that's going to cover all your losses. Okay, then step number 3, you're gonna enter with confirmation, which is what I've said just now. Now you can entry with confirmation with candlestick pattern, okay, once it has support line for the third time with a bullish candlestick signal. If you use RSI, okay, it went from below 30 back to above 30. The best entry you can make is when the price, okay, went from below support line back into the range. So a good entry point right after this candle close. Because the thing is, you don't want to enter here. It might be a breakout. It might be a false breakout. The safer way to enter is when the price got out of the range and then come back inside. So you can see that on the third touch, you see this bullish candlestick pattern, this 3, 1, 2, 3. Now you will say that this is a morning star pattern, but ideally I would want the third candle, which is this candle, to be smaller than the first candle. But if you learn to read candlesticks, you don't need to follow fixed rules because this tell you that a bias up winning the game. Agree with me? There's a strong bullish strength. If you watch my previous candlestick video, you understand what I'm talking about. Now, when you're trading range, just be aware that, okay, market doesn't range forever. That's why I say don't go in on the 5th touch, 6th touch, because markets by then would probably lost its ranging momentum. So don't be so greedy and then go and sell and then go and sell. When it tests again and again, on the 10th time it tests resistance, you go and sell again. Just wait for the next range to come. Just wait. Don't need to rush the whole entire process. One danger about the markets giving you false breakouts like this and like this is a lot of people, when they see this breakout, they are going to open a new position. They're gonna buy right here because they just got stopped out, right? They just got stopped out. They sold here and then markets go up, they got stopped out. So it's very tempting to get back into the market to so-called trade the breakout, only for the markets to come down and get stopped out again. So what's my point? My point is that as a range trader, you need to also learn how to identify false breakouts, because it's gonna happen really often. It's gonna trick you again and again and again. But like I said, the safer way to go to trade a range is when the price went beyond the range and then come back in, like what I mentioned just now. It's a lot safer. Okay, so guys, hopefully this short little tutorial could help you. Now, if you want to learn how to identify false breakouts, I've already done a video on that. I'm going to put that into the end screen. So with that, I'll talk to you in the next video. Bye.